Hello everyone! Welcome back to the RationalInvestor.com's Weekend Frivolity. Are we on YouTube? We are! RationalInvestor.com. Hey, hello everyone. Threw the hangout together pretty quickly, following class here. Hopefully that was a half decent dovetail for you guys. Sure is some heavy lifting the level oneers are having to do here right now. So I appreciate we had a fairly lengthy class with the Wookiee here today, but just like a rock star, he just didn't change his pace or his cadence or his tone or anything through the whole thing. Just slow and steady. It's beautiful to watch him in action. Also too, Sharktoshi and Kavarkanator. Great supports. It's a real privilege to work with all of you guys. So congrats. And like I've told people before, I kind of like this weekend show. Who knows if there's even going to be anybody in the public watching this or not. But I like to build this as a dovetail to the school program as it's going, and then sort of answer any follow-up questions. I don't know whether you're following my Twitter feed here, but yeah, I've been a little bit chattery here of late. Man, sure is a lot of fun stuff going on in the world. And of course, we've got our big fundamental event on Ethereum that we've been waiting for a while. So obviously, we've got a big catalyst staring us in the face. So at least now, we're through the end of the year. We're through that Jupiter-Saturn stuff, coming out the other side. We're probably going to have reverberation kind of events through the months and quarters to come. But I can already start to feel that sort of the tone is changing a little bit. I know we have Andre. I don't know whether you're here today, but we have one guy who's watching the EVUs closely, and I have to say, they've been helping me a lot. We had an EVU recently, and actually in the DeFi space, you really see the reaction coming out of that sort of energy release event. Man, that market just exploded higher. I wonder if a little bit of the Ethereum space is being a little bit affected by almost like a cross current. It feels like there's almost like two completely different motivating sort of factors going on here. They always, lots of sort of references online stuff, history never repeats itself, but it often rhymes. I do see that kind of stuff. I doubt this ETH event goes exactly the same way as the Bitcoin event went with the CME. We are under very different circumstances, very different environment, different political backdrop, different societal backdrop. Somebody over there on YouTube's mentioning Robinhood. I mean, I don't think Robinhood even existed back at that time. Actually, I will say that trying to time a top in here, if there is one, it's going to be tricky. Just pull up your charts from the last cycle. I mean, I don't think, number one, and this is a really good anecdote of let's call a spade in this space. We ran our fun little education program and all that kind of stuff through the last cycle, and it's so sad because I do remember one guy in particular. I don't know whether he's going to watch this, if he even pays attention or not, but I came into the space back here, and Julian and I launched our sort of education program and just sort of our basic program right into this. And actually, it's funny because I was even chatting with somebody on social media about Tim Draper today, and Tim Draper came in and bought the Silk Road auction coins right here. Actually, I think it was on this event right here. Mr. Draper, I bought some of Mr. Draper's rebonds and just he drove that into the ground. So I don't know, if the person who I was chatting with on social media happens to be around or watch this later on, I don't know whether I would give him a lot of credence. It's almost kind of like that guy on CNBC who pointed out the exact way to lose money on Cripple years ago. You remember that? And he was the promoter behind this cryptocurrency Nautilus coin, and it basically was a total fraud. and what kills you in this world, right, is a total fraud. Everybody lost all of the money invested in the guy, and yet he still gets a job on CNBC. How the hell does that work? Oh, this world, I swear. Anyway, that's here nor there. Point here is... what the hell is the point? What was I talking about? I can't remember. It's crazy crypto market, up and down like a horse drawers. Be careful here, folks. I don't know if somebody can remind me if there was some earth-shattering point that I was supposed to be making about all this. I actually, you know what I do find interesting, and I was sort of commenting about this recently. I wonder whether we're still in this kind of environment over here. Versus like this kind of environment. I wonder. Maybe Ethereum is doing this kind of thing right now into it. I don't know. That's a tough one. But I'll tell you, if I was going to actually hunt for a short trade setup as a professional futures trader kind of thing, I mean, this is setting up exactly the way I'd want it to. So, candle body highs, reload zone. What's so funny is even on Saturday, I think it was, I found that there was a price gap right up against in this high, and I tweeted out, these gaps, they have a funny way of getting filled, and sure enough, the market went right up, filled the gap in, and then basically our top since that event is what you're seeing the back off from here. It's very hard to tell what the hell's going to happen here from day to day. And this is kind of where, like traders, they don't really have an opinion. They just come in and go, I've seen this happen so many times before. If I get a rally up against highs, then I'm probably going to step in. It's interesting to see how we've got huge wick, huge tail developing now. It almost felt like they're about, maybe about 3 or 4 hours. The people in the DeFi space started to unload. And that would sort of, I don't know whether they unload into Bitcoin, but I think you could really see that in the Ethereum. And, to really see that, of course, you see it in the, where the hell's that damn DeFi Index? Got around here somewhere. Yeah, that's DeFi Index. And what's so cool is that we got a couple guys on the site who took sort of the basic chaos theory principle that I was sort of given, and then they crunched some more numbers, and they came up with this 877 level, and it's, mathematics, all the Hoagland stuff. Fascinating how the market ran up to this chaos level, consolidated, fight there, support. I mean, that's a hell of a level there. Then went zipping up top here, and then M'd out just above it, and you can see the market's fighting with that level again here. But it just kind of felt like there was just like a swoosh. Somebody just said, all right, time to, what are those Russian guys, Everybody has those funny pictures of them, the Roganovs or something like that. Pep it! I think somebody just said, that's it, pull the plug, and down she went. But interesting enough, you can see that it's it's rallying back here smartly. I suppose markets never go in one direction forever here. So I still think that Ethereum is the show here. I don't actually think Bitcoin's the show. I think Ethereum's the show. I am fascinated. I don't think, if this was left to Wall Street's devices, if this was left to Whacker Street and the guys running the CME, I think they would have just kept moving this thing higher nice and politely right up into this event. I don't know what the price of it would have been. And I think, like I said, and this is what I've been saying to the community here this morning, is it feels like there's two cross currents here that are fighting each other. And I get the impression that the DeFi kids were like, you know what, we better get out while the getting's good. Let's book some profits. And now the CME boys are like, okay, well, maybe we got the kids out. What's fascinating is the dump, of course. It actually corresponds perfectly with several kind of concepts that we like to follow at TRI. So it doesn't really surprise me that there's a bit of a bounce right at Mr. Hoagland's level. Oh, and by the way, I don't know whether I'm going to get into trouble doing this, but oh man, I was damn impressed. One of our site OGs is now hanging out with Mr. Hoagland in the morning over on Top Step. And I was so... I said, like, literally, I mean, I love John Hoagland. If you're ever going to work with a professional in the futures industry, these are absolutely the people that I think you got to work with, because most of the people in the futures industry, they're just real, they're not nice people. So we were really privileged that I've been able to send some people over to their place. I love that. But now, one of our site members, he's a big fan of cats and stuff, and he actually got John, and we got him on a sound bite. Literally, I start my day thinking this line.
Oh, and meow. Oh, and meow.
I mean, what does that mean? Just it means hello and meow. What does that mean? Just I probably screwed that up, and I have no idea if you were able to actually hear that or not. But I'll tell you, that really put just the biggest smile on my face, Shayna. That totally was awesome. It was just absolutely, and so all my students, right? I adore John Hoagland. I think he's an absolute gem of a human and just one hell of a trader. This is the icon that I use on my charts to denote where John is actually going to be acting in the marketplace. So, as you can see, and people that subscribe to like technical analysis, scrolls, all that kind of stuff, right? They call this a Wyckoff check, where the market breaks out, comes back down, and it just simply asks, are these W's for real? Is there actually demand here? And you can see, yep, it looks like there is some demand. Did hear some people, of course, pointing out that there is a pump underway by a whole bunch of Hollywood people that seem to have gotten into bed with our little technology. Is he a trillionaire yet? So he's rubbing shoulders with the Hollywood peeps now. It's interesting. Actually, I guess two. Well, I guess one older music person and one sort of, I guess, middle-aged? Would you call Snoop Doggy Dogg middle-aged? I don't know. And Gene Simmons, who I think is officially a senior citizen, but I'm not quite sure. They're now coming in onto the Elan Monks pump here on Doge, which is totally fine by me, but the only problem here is, this is a weekly price chart. I'm not the type of person that can come in on the buy side here. Unfortunately for a guy like me, I actually look at it the exact opposite way, that, we had the patience and discipline to buy when, nobody wanted this shit. Or whatever colorful acronym you want to call these coins. But now that I am in, you want to pump this thing, that's fine. I'll be more than happy to sell you more coins higher. And this is sort of where, unfortunately, people get into a little bit of trouble in this world. And I think it's extremely dangerous. Like, I think this person here, this gentleman here, all the story. We don't need to go into that shit. But, people, what I see they're doing right now is they're actually, like, expressing their angst and their frustrations and their emotions with their pocketbook. I tell you, folks, that's a potion for disaster. So I'd be really careful here. The interesting thing is, probably if you are actually watching this YouTube video, or you have been watching for a while, you're probably not the type of person that's going to get sucked into this. The problem is the people that are going to get sucked into this, they don't have a fucking clue what price charts are. They got no idea. They're just told to buy and they buy. So, if anything, what I sort of suggested to the level 1 students, first thing this morning, I was like, oh my goodness, people, this is a beautiful environment for you to learn. Just watch what happens here. I mean, maybe the thing goes zipping up, maybe it comes zipping back down. But the point here is, we as market participants, if you're not in this story right now, you got no business coming into this story. But, so what? I'm sure there's a lot of people that'll say, yeah, you're wrong, Brian. This time it's different. Uh-oh. And actually, I did hear somebody actually utter those lines when somebody was trying to explain the ETH rally here and how the CME event probably won't be the top because, quote unquote, this time it's different. As soon as I saw that, I was like, fuck. Because the rule is, it's different until somebody says, no, this time it's different. As soon as they say that, then you know that this time is exactly the way it always is. But the fact that they're at the point saying this time it's different, that's our cue that, okay, the dream has been shilled to the public. The public is long. The public has now invested. They have a vested interest in this thing going higher. And does anybody, I'd be curious to see, what is the market's job? Anybody on YouTube know this answer? It's actually a pretty long answer. Yeah. Oh boy, that's about 15, 20 words. So that's probably, it's probably too much for a YouTube request. There you go. Everybody in the lounge is getting it. Yeah, it's a lot of words, isn't it? So I worry that, and this is the message that I told the community this morning in the lounge. I mean, if you look at something like an Ethereum right now, maybe off of that time frame, it's not the best to look at it. Where's the higher? There we go. So something like this. Remember Brian's a chicken shit, right? So, Brian, can I come in on the buy when we're up in here? No, can't touch it. No, fuck Brian. I mean, Jesus Christ, look at it. It's just well, you can see where my buying zones are, and I just have to keep drawing the damn thing higher and just wait and wait and wait. I mean, trust me, I'm a chicken shit. You already know that, so you don't need to trust me on that. You already know I am. So, at best, I have to draw my tools that look something along those lines and something along these lines. And you notice that the reload zone boxes don't really change a hell of a lot. I guess that's basically the same level. So, you can see where I would be comfortable coming in on the buy side. Could this thing keep working its way higher? Sure. It can do any old damn thing it wants. So, oh goodness, that's quite an environment. Actually, I was joking with, I think even probably, actually, isn't that interesting? Oh, we got actually an M there coming in on a trend line break. Uh-oh, SpaghettiOs. Actually, our little trend line traders, that would probably be, let's see, what would that look like? I wonder, would we have to take the whole M? Geez, that's an awfully big MA. I don't know whether I could take a trade that big. But let's see. We'll just throw that on here. And actually, in the daily brief recaps and stuff, interesting how that just parks right in the middle of that reload zone against that trend line, eh? Coincidence? I wonder. Yeah, it's incredible how cliche this shit is. We'll keep an eye on that going forward, but that's not really what I wanted to mention here. What was I going on? Actually, you know what? I talk way, way too much. These videos are way too long, so let's just get on to the questions. Probably make this nice and short and sweet for you guys. Boom. It's over here, I think it was, right? Yeah, here we go. All right, so let's see what happens here. A couple of years ago, I heard someone saying that the smart money was getting on ETH at 100. Could be. I guess they're smart, eh? What is it? It's like 1700, so 17x. Not a bad trade. All right. I tell you what. Why don't we go through the questions? There aren't too many here. Then, if you guys are still interested, you can ask me to look at different stuff. Okay, that's probably the best way to do this. Don't need to sit and listen to Brian blabber on without direction. Okay, so question number 1. Hello, Brian. Hello, you. Specific to the market breadth charts on the TRI dashboard, please explain the difference between the fast ratings and slow ratings. Are the chart tables based on the advanced decline in price and or volume? Unfortunately, this is actually quite complicated. Have to go through and actually one of the jobs I have to do here, and I'm just waiting on the tools just getting crisped up to the point where I think I can do the presentations cleanly on YouTube. On this site, I'll actually go through and explain what the hell's going on here. But one thing that you don't see here actually anywhere on this and anywhere on the site is the actual DI mechanism, which is something that Stuart and I think are going to have to address. Simple answer to your question. Every issue in a particular sector, so S&P 500, and this one happens to be the country funds, Dow Industrials. So every single component inside that index has what we call a DI rating. What the hell is a DI rating? In our level 2 program, we spend a good deal of time explaining how you build algorithms to give you technical tools to sort of gauge either the health or real health of an asset, or to help you time purchases. And now you can build scripts on site like TradingView and stuff like that to trade off of those. So this particular script accumulates 15 different technical indicators that are volume and price based, and then does it off of 3 different time frames to create a cumulative technical score for an asset. Then the algorithm applies a moving average system, and in essence, the fast moving average above the slow moving average is a bullish reading. The fast moving average below the slow moving average is a bearish reading. That's pretty straightforward. And if you have to hit the rewind button and play that back 2 or 3 times to understand it, that's cool. If you're in the level 1 program, my suggestion would be a lot easier just to complete the level 1, concentrate on the stuff you have to learn there. And when we get to level 2 and we show you and give you the DI scripts and all that kind of stuff, it'll be far easier to understand. I'm not going to go through and walk through the whole scripting stuff. That's like I said, it's a full week's worth of work in level 2. Point here is each and every one of those issues within whatever respective index gets a score, a bullish or a bearish score. And then what we do is we apply a bullish percentage index, and Google that. You can go on stockcharts.com. In fact, in the level 1 program, the part of the breadth indicators matrix that we give you, where the hell do I have that link? Does anybody have the level 1 internals link that I share with everybody? If you happen to have that handy, it's that stockcharts.com multiple thing. No? Okay. Anyone? Okay, well, here, let's see if I can find it here. Just, where do they have that? Oh, yes. Anybody got that handy? I've got like a 4 or 5 chart matrix that I hand out in the level 1, and it's got the bullish percentage index here for the S&P 500. I don't have it handy. Bullish percentage index. So it comes up here. Oh, that didn't help. Blogs, public chart lists. Okay, why did that not work? Bullish percentage index. Should have worked. Yeah, it's in the this week's technical analysis under intermarket analysis relationships. It's a template that I give you guys. I just don't happen to have the Thinkific platform open or the school module. I mean, if you want to just somebody, Grim, you're on the call, aren't you? Somebody find that link for me. I'd appreciate it. Or maybe I'll just find the link here. No problem. We'll figure this out one day. Now, why can't I find the bullish percentage index? What is going on here? What am I doing wrong? Anyway, my brain's not thinking. It might be in here. Let's see what we got. Market breadth. There we go. Hello. So we've got volume, bands decline line. What do we got here? That's up volume versus down volume. Where maybe is there another one in here? S&P bullish percentage index. Yay, we got it. Sector. Well, actually, sector. All right, and this is basically the same thing. So, what you're looking at here, if say we take consumer discretionary, right? There's like, I don't know, 30 stocks in that index. So the way that the classic bullish percentage index is calculated is they use, I think it's a 3-bar point and figure reversal pattern system. It's pretty straightforward. Level 2, we go into point and figure charting. So if you, thank you, Alex. If you want to learn, actually, do we do level? Yeah, we do point and figure in level 2. It's been so long since I've done the level 2 program. I got to get back in there with Q Ryan. He's so awesome. Bullish percentage index, you can see these are all the different sectors in the U.S. market. You see how they have sort of up and down signals, right? Well, this is just based off of whatever's in the index, whether it's a buy or sell signal based on a point and figure chart. That's the way it's classically been calculated. What we do is we do a bullish percentage index off of what the assets in the sector, right? What's in here, whether they're issuing DI buy or DI sell signals. Same thing. But instead of using point and figure charting, we use DI buy and DI sell signals. Whew, that's a mouthful. Very complicated. There's probably no way in hell you'd be able to build this on your own. And like I said, I've been waiting 3 years for this information very patiently. And Sjord's delivered like a rock star. If you wanted to see a typical, like a stock market similar, like it'd be interesting to see how similar the Dow Industrials bullish percentage is right now. Where was that? Bullish percentage, major sector, market. Let's see what we get here. Maybe. What do we got? There's the Nasdaq 100, S&P 100, NYSE. Dow. There we go. Okay, so there's the Dow. Chart looks kind of sloppy. Yeah, I know. You want my subscription. Let's see if we go line chart. Something like that. And we'll get rid of the indicators. Oops. Hello, somebody wants in. All right, so there is the Dow Jones Industrial Average Bullish Percentage Index based on point and figure buy and sell signals. So you kind of see that kind of ME. We jumped up here just a little bit. Let's see if the DI looks similar. So there's the Dow, there's the ME, and you notice the jump up here a little bit. So it's interesting how, we often say in the market a good trade is a good trade is a good trade. If you're measuring something like breadth, there can be like 50 different ways to measure breadth. This is the way I like to measure breadth. You could use the classic Bullish Percentage Index, which, like I said, is based off of point and figure buy and sell signals, which is fine, but it basically gives us the same message. So I sure hope that helps explain that. What do you think? Is anybody here is like, okay, I think I understand how this thing works now. Anyone? Shane? What do you think? Does that make sense, Shane? Since you're the only one interacting with me here today. Well, nope. Didn't work with Katrin. That's too bad. Maybe go back and watch that a couple more times. I said a heck of a lot there. In level 1, brand new to trading, I really wouldn't worry too much about this. You're just going to be breathing this over the next year, getting to know your job. What does my life as a trader look like? And you'll start to clue in. When you see M's in the breadth indicator, that's usually bearish. When you see W's, it's interesting how, Bitcoin and ETH and the majors are rocking and rolling here. That's usually bullish. Yeah, I know. What do you think? Are you getting your money's worth? That's the question. At the end of the day, JD, do you feel like you're getting your money's worth? Some people are critical of us, charging, but I don't think we charge too much. I think we keep the number pretty low considering how many people work on the staff here with you guys. And we certainly go over the top here on content. All right, there you go. So Peter Sachs says he already learned something new every day today. Okay, well, hopefully we helped answer that question. However, I think it's a good idea if you do post a question here to put your name or initials or something just so I can talk to you. And then, see whether if there's any follow-up or anything that's needed. Okay, so the next question looks like it's basically the same thing. Could you please tell more about market breadth? I cannot understand how it works and how it is created. From what data? What is advanced decline line? Okay, well, I think I sort of went through there with like bullish percentage, which is a great simple way to measure how much of the market is feeling uppy and how much of the market is feeling downy at any given point in time. Where the hell's the stock market one I have here? That's crypto. And I got crypto over here too. Oh, that's how corrupted I am here this weekend. Okay, here's our stock market breadth tool. So this is the classic advanced decline line. And what I like to do is I actually like to do a bunch of moving averages on these, because if you actually look at the advanced decline line itself, it just looks like a mess. What the hell's going on there? What we're really trying to do is we're trying to identify, hey, it looks like there's a rising trend here. And then conversely, hey, it looks like there's a falling trend here. So the way that we like to do that, of course, is slowing this choppy information down through looking at things like moving averages. So here you can see the trend is rising, the trend is falling. Later on in the program, we'll teach you how to sort of interpret these moving average relationships. Don't really need to worry too much about that right now. All that you really want to do with these kind of breadth indicators is try and see, are there W's coming in here? Meaning, hey, something's going on. to the upside. Something's happening here. And then conversely, after whatever this was that got everybody all excited, do we start seeing M's come in here, i.e. whatever that was, it's playing itself out. And it's done. And then, notice, oh, gee whiz. Looks like the market's trying to turn here. You can even see in the moving average right here, look at that cute little W. So you can see something's trying to get going here to the upside. What do you think? Have you guys noticed in this stock market? Are people feeling kind of more barstool-y? I can tell you, 5 years ago there were no barstool characters in the stock market. Nobody wanted to buy a fucking stock. You couldn't give it away. Now all of a sudden, oh my God, the stock market's all the rage. This is probably more, though, like a seasonal picture, where what you're really doing is you're sort of seeing the ebb and flow on a seasonal basis, money flowing into the market, money flowing out of the market. So, but, like I said earlier, the most important thing was something like advanced decline line, and you're asking, what the hell is it? Like, I don't understand the mechanics of it. Really, all it is just think of the stock market as a whole bunch of individual stocks, because that's really what it is. And a lot of people actually get confused by this. Are you trading the stock market? Well, the Dow Jones Industrial Average, S&P 500. Or are you trading a market of stocks? You want to see crazy ass returns and trading a market of stocks? Come into TRI and hop into those crazy warrant trader guys. Oh my goodness. The profits at Colleen, guys. Our official resident little old lady is a warrant maven. I know for certain, she's got some poor Amex warrant market maker broker shitting his pants to come into the office every morning. You know it. You go, oh damn, this person's gonna steal more money out of my pocket. Hey, and have no sympathy for those hedge funds or those. I remember years ago in the crypto space, one of our guys actually put one of these CFD forex brokers actually put him out of business. So, TRI, we build fucking kick-ass traders, and these traders will bankrupt firms if these firms get cocky in the face of them. You know what I mean? Fuck, if you strapped on a whack of GameStop calls there heading into that rally, I mean, jeez. Poor old Gil. Good line. Excellent line. Well said. That's perfect. Okay, so back to our story. Brian gets all distracted by shiny objects. Okay, so at any given point in time, really, you could think of the stock market as a whole bunch of like little soldiers that are all lined up here. Let's go this way. And I don't know. Does anybody know how many stocks are listed on the New York Stock Exchange at any given point in time? There's something like 10,000 or something. But I mean, it's staggering how many stocks are listed. Just huge. So let's say hypothetically that our fictitious stock market has 5 stocks in it. And on this particular day, we look at the market and we see that, hey, 3 of the stocks in our stock market are up, and 2 of our stocks in the stock market are down. So the breadth of the market is, I don't know, +1. Does that make sense? I suppose if we flip this around and, actually, here, why don't we'll do this guy. And we put him down there, and it turns out he's red. Well, on that day, you'd say the breadth of the market is -1. It's just that simple. That is the breadth of the market. And so this reading, you can see +1, -1, blah, blah, blah. That is what that looks like. And actually, that's even smoothed. In reality, what it looks like is that. So, how the hell do you use that information? It's gobbledygook, right? It's just a whole bunch of dots on the line. So that's why we do things like change it to a line chart so we can start kind of see the direction things are going. Like you can kind of see, geez, we're making higher highs and higher highs. Something's going on here. And then what you really should do when you're using something like this is, there we go. Use moving averages, sort of like what's the average. And what that does is it tries to smooth out the signal. So what do you think? Is that a pretty good answer as to what the hell breadth is? What the advanced decline line is? Does that make sense? Oh, who asked that question? Let's see. Maybe they asked. They're answering. Yeah, Brian, that was awesome. Let's see. Andre J. Wonder where Andre J. Are you around? Looks like somebody sneezed on the chart. Well, Andre says, "Oh, look at that! Awesome! Woohoo! Everything is awesome." Okay, simple question. Can you explain the difference between price log charts? And when would use one versus the other? Or why? Thanks. All right. It's actually, believe it or not, it's actually a pretty complicated answer. Complicated question. It's really probably a question of what kind of market participant you are. So, like people who are like Bitcoin maximalists, all those kind of people. They're thinking about the growth of the network. I don't know whether I got them in here somewhere. But remember we used to do those fun charts with those curves? And remember that there was a really cute guy? Remember when Bitcoin was down at like $4,000? We used to listen to that guy. Really cute guy talking about the geez, I can't even remember any of those guys' names. Anyway, I used to have like a 4-chart matrix on here, and we used to have the fun S curves and the sort of growth rate of Bitcoin. And then, probably the, so let's see what to show you that. Actually, well, no, that's another conversation altogether. Okay, so if we go, actually, I don't really want to get rid of that chart. Let's just do a new one. We'll call this the Broiler Chickens template. So whatever we do here, whatever happens in broiler chickens stays in broiler chickens. All right. So, I want to look at this asset and understand it as a growth proxy. What is its growth rate? Benjamin Count. Thank you very much, Peter. Oh, you're awesome. Peter, I was talking to the kids today about price risk versus information risk. I think that was you who shared that with us. That was such a great piece. Maybe it wasn't. Maybe it was somebody else. But it was great, awesome. Great, awesome. So, from this perspective, if you look at these moves, right? I mean, clearly you can see. Do those look like 45-degree angles? Mr. Gann would say that the natural growth rate for an asset is 1 unit of price for 1 unit of time. So that means that your growth rate on your chart should probably look something like that, right? So, you get into this kind of environment. I don't know where you're going to do the lows. Doesn't really matter. And when we get up into this kind of stuff, you got to look at this and go, geez, this is looking a little ridiculous. I don't know whether I have the time scale right here. It looks like it's off. Actually, I have another cool chart with all these done up, but So, like to understand the natural growth rate of an asset like this, you wouldn't look at a price chart like this. It just doesn't make sense. So from a natural growth rate perspective, we'd want to look at something like a logarithmic chart. So this is like, quite literally, this is like a graphical representation of the growth of this asset. The good part about this is that one side of the equation is relatively fixed. So it works for this kind of concept. In essence, this image is nothing more than a graphical representation of the growth of demand of the asset. And since the supply is relatively fixed, as long as demand grows, then it'll probably follow along some sort of logarithmic growth rate. And really the way you use this is you just simply use these opportunities, and I've seen this repeatedly in this space, that these opportunities basically represent a check of value. This is where the public's getting all ape shit. And what you find with the cost of production of this asset, because the supply is fixed, and it's got that fixed algorithm on the supply, it just basically, it will follow this natural logarithmic growth rate. And actually that might also be a function of this too, because the payout is very set. To a certain degree, this is a rise-only market. And the question ultimately is, these peaks just simply represent the euphoric over-demand of the asset. That would probably be the way that I would look at this. Because that cost of production number is always rising at a geometric rate. It's not a, is that right? Maybe that's not. No, it's rising at an exponential rate. It's not rising at a geometric rate. So because of the exponential growth rate, you have to sort of look at it from a logarithmic perspective. And really, it's probably the only reason why it does, and probably your POW coins, probably the reason why they will rise at a exponential rate is a function of, number one, does the market actually believe in this thing? And number two, that rising cost of production is actually a fairly fixed number. I've often said I actually think investing in Bitcoin is actually really easy, and it's really cliche. And because this thing is algorithmically based, you can actually almost time the euphoric peaks almost perfectly. It's just the problem with this is, for God's sakes, don't chase, don't chase, don't chase, don't chase, don't chase. You know how that cliche goes. So it is interesting that we can do this on like this logarithmic growth chart on Bitcoin as a cryptocurrency, because I think the supply is fixed and that algorithmic payout. Whereas something like XRP, as just an exponentially growing asset, ironically enough, when you look at it from an exponential or like a logarithmic growth chart, I mean, that could very easily be accurate. Doesn't really look like it's going anywhere, right? One reason you might argue, maybe more people are using it, but they just keep, printing more supply, right? Like, what is the supply like unlimited? I don't know. I don't know whether that works here or not. So I think that's one of the main reasons why the Bitcoin logarithmic chart works so well, is because it's just so tightly tied to that cost of production increase that is basically logarithmic. In the stock market, we want to look at, actually, maybe I'll take something like Amazon. We want to look at stocks from a logarithmic perspective because, well, the supply is relatively stable. Now, keep in mind, these damn things, they can continue their supply growth immeasurably. So it's not like that is set in stone, and actually a lot of companies, they end up getting themselves into trouble because they just issue too many damn shares. But looking at it from a logarithmic perspective, this is actually an interesting image. Why is it that this growth rate actually looks like quite a bit steeper than this growth rate? Well, it's true, but what you have to understand with companies is, at these kind of prices, let's say they have like, I don't know, what's the best way to say this? Let's say the stock is $1 a share, right? And they grow earnings. Let's say EPS is a penny a share. It's trading 100 times earnings, whatever. It doesn't really matter. But in this case, they grew their earnings by a penny. So that means that the end result is now their earnings are 2 pennies. That's down here. That's a pretty damn big jump, right? I want to do Amazon and M2 chart, eh? Let's just answer this question first, then maybe we'll go there, okay? But to understand why you'd use a log chart in sort of stocks, right? Again, thinking growth, what you have to understand is the impact of, say, a penny per share increase, where quite literally this is doubling earnings. That's 100% earnings growth, right? But what happens when the company earns an extra penny? Let's say they go from, say, 99 cents. Well, that isn't nearly as big of a growth rate, is it? So it turns out that's only a 1% growth rate. So how do you reflect that? Because keep in mind, these reports are earnings per share. So what ends up happening is, as of course the price goes higher and higher and higher, the earnings, to keep that growth rate the same, they actually have to, like, the numbers have to grow at that same exponential rate, which is almost impossible. So this should be a very clear illustration of the difference between Amazon increasing its earnings by a penny a share given the different relative price, and why it has effect. When you look at the regular price chart, of course, it looks like that. How the fuck do you interpret that? Does that make sense now? Why you would use a logarithmic growth chart to try and understand the impact on earnings per share and the relative growth, sort of the pace, the speed, the tempo of growth? Yes, no, maybe so? I don't know. Sure hope so. So, I don't know, this person who asked that question here, let's see. Are you here? Doesn't look like it. Oh, Anonymous Raccoon. Raccoon, is that you? Yes, no, maybe so. Okay, so that's sort of why you would want to look at log charts, is that idea of we're trying to measure growth. And what's healthy growth and what's natural. And interestingly enough, when you actually look at this kind of chart from a logarithmic perspective, you can actually do things like just simply go, well, it kind of looks to me like this company is in a bit of a channel. Boom, boom, boom. So you can actually see from this perspective that earnings have actually kind of slowed down over time. Can you see how we're losing that channel? It's kind of cool. And it makes sense because, how fucking big can this thing keep growing at a bazillion % forever? Probably not. That's not very realistic. So also, too, you can actually see the rate of change of that growth as well. So it's kind of cool image. If this thing had just kept going along, then it probably would have just stayed in that channel. Now, the interesting thing is Bitcoin probably has a much greater chance of holding a channel like this because it's got that algorithm. that says that the halving must fall in half every, 24 months or whatever the hell it is. So it'd be interesting if we look at that so you can kind of see, here was maybe a little too far too fast. But I guess I could kind of think, gee whiz. Okay, well, you can even see the growth rate of this thing slowing down a bit. So there was, interesting. So that 20,000 peak actually just came up underneath that. Fascinating. So interesting how our growth rate, actually, I don't know where we'd want to go off of that. We might even go off, well, I guess I did do that. I would have originally gone off of something like that, which is interesting because if we can get back to this original growth rate path, that says that paint's way up in here. That's right, all the moon boys, they all want to see that. Chart like this, though, is a little dangerous to come in here and go, okay, well, that's a good buy there. Because keep in mind, on our regular scale, that's what you're looking at. So you can see on a log scale, that doesn't really show up. This is what gets so scary about Bitcoin, is it could fall 50% here. 50%! Well, I just inherited $5,000 from Uncle Louie. I went and bought Bitcoin. Boom! 50% drop. That would actually be very normal. Wyckoff check, all that kind of nonsense. And, on the log scale, barely shows up. In actual fact, this is kind of cool. If I'm not mistaken. Yeah, remember I had those cool, geez, I can't remember what I did with those charts. Those cool, sine wave charts and shit. But what's kind of cool about this, if I remember off the top of my head, is this reload zone. What is it? There's some study or something like that. And that's it. That's whoever said that person's name, Benjamin Cowan. Peter, what was his study? What was the name of his study? Do you remember that? You guys remember? Anybody remember what the name of that study was? Anyway, point here is I seem to remember his study actually said that value or whatever the hell it was somewhere right in this area. So right now you can see the reload zone somewhere between about 18 Gs and 11.5. And you look at this from a log scale and you're like, oh, okay, well, that's not very far, right? But you look at a regular scale and you go, oh, gee whiz, that's all the way down here. So it might help you visually see just how much risk you're taking. That maybe you study your assets from a growth perspective. What does growth look like? Are we on schedule? Are we growing? Maybe we're a little too far too fast. And then use your reload zones. I seem to remember there was some trend line or something that he... was it the 400-week moving average or something like that those guys like to follow? And I seem to recall that it's down in this area as well. So, okay, so that was to try and explain why you use a log chart. Now, why would you use a regular chart? And the simple answer there is, as let's say crude oil, for example. That's the easiest way to think about this. If you're going to buy something like a crude oil contract on leverage, then the contract is 1,000 barrels of crude oil, right? So bang. And they're going to ask you for a margin requirement. But in essence, this contract is for 1,000 barrels. And they're going to ask you for maybe 5% margin or whatever the current exchange requirement is. So if I want to trade this on a daily basis and make money, day trading, then really what I'm thinking here is I'm going to buy this at 57.07. So we'll even say, boom, buy 57.07. And quite literally, let's say I have to close the position at the end of the day. Let's say, boom, down here. What's that number? Just got my ass kicked. Oh, Jesus. 50, what does that say? 56.62. Bang. So I spot at 57.07, sell at 56. What the hell was that number? 62. The value of this contract itself is actually what's at stake here. So the value of the contract in this particular case, I'm buying. This means this contract's $57,070, and this I'm gonna sell it, and it's 56,000 and 620, eh? Which means I'm short. What is that? 450 bucks. I gotta make that up. I'm going to put on like 5% of the value of this contract. So just roughly, what is that? About 2,800 bucks or so. Say 2,850. And okay, fine. You can have your 2,850 back, right? Because you put that up. And what they actually call this 2,850, they call that a performance bond. So it's not even like you're buying this. It's just sort of like collateral you're just putting up. Hey, you get to control this contract. But at the end of the day, you got to settle up the bill, whatever the hell the damn contract's worth. So in this particular case, you lost about 50 ticks. You got to put up the 450 bucks. Log scale doesn't make a rat's ass difference. If this is down here at 55.60, well, sorry, pal. At 55.62, now you're talking. What is that right there? You're gonna, you're liquidating at 55.650, or I guess we'll keep the numbers the same. Jeez, my eyesight is getting terrible. You're going to get your $2,850 back. There's your performance bond, but you got to make up the difference. Now it's minus 1,450 bucks. You got to make up that. Just as simple as that. So there's really no point in looking at a logarithmic chart. I'm not trying to figure out growth. Every point movement is exactly the same. It's whatever the value of this contract is, and of course it works the exact opposite if it moves up in value. Whatever the difference is, that's what's in your pocket at the end of the day. Make sense? Hope that helps. Let's go back to our question document and see if I did a half decent job and whether the person says I did. Okay. Well, there's a thanks. I don't know whether that's person, but I hope that helped answer that question. Also, too, this works the exact same thing on cryptocurrencies. You buy all these, various different cryptocurrencies now on leverage, on margin. There's no point in looking at a logarithmic chart on one of those. You might as well look at a price chart. 1 point is 1 point. Okay, next question. Brian, what intermarket would you recommend for Alt Crypto Hunter? Intermarket. Well, there's a bunch of them that I follow. Don't know whether I show you guys. I think I do in the course program. These are all the different studies I like to follow, sort of the internals of cryptocurrencies. I think actually this is the best tool. And by the way, it's flashing a massive sell signal here. How ironic. This is a tool that has absolutely nothing to do with the CME or Winkle Dinkles or Barstool guys or whatever. It's all just purely internals of the Bitcoin network. Great, and it's perfect because usually it's sort of flashing warning signs as we're face ripping up. And then when the market's correcting, it's basically going through the correcting process. You can see the signals; they work pretty darn well. I'm a little concerned here, and also too, I've heard people on social media and stuff going, no, this time it's different. Oh boy! So as soon as I hear that, oh fuck. I mean, maybe there's gonna be some monkey business around this top, but this is a really good. It's NVT. I think it's a great intermarket analysis relationship tool just to sort of see the internals of the Bitcoin network. We like to follow the Bitcoin market cap dominance. This has been a fantastic tool to sort of tell us when shitcoins are in preference or when Bitcoin's in preference. There's also these other totals that are derivatives of this. So that's a cool tool to familiarize yourself with. You know who's really a boss at this tool on the site is Colin, and he's over, I think he has like his own show and stuff over at that Hero site. So if this kind of intermarket analysis relationships within crypto appeals to you, I would suggest you chummy up with Colin. He's a great guy, super nice. Canadian, so he's got some ethics. Arr, arr, arr. Hey, us Canadians got to stick up for each other, man. Well, not you, Shade. Anybody but you. Just kidding. Let's see. What else do I like to follow? We got a bunch of these different alt indexes that we've been following through the years. You can see, I think this was one of Joshua's indexes. Looks like it blew up a while ago. Oh, I think like a couple of these have been delisted from Trek, so not surprising. Binance. There's the shit perp index. Not even swearing. That's what its name is. In level 2, we'll talk a little bit more about things like the forwards markets and futures and this concept called contango and backwardization as a sentiment reading. I haven't really commented on it too much of late because, I mean, what do you think the sentiment is within this space right now? Actually, I'd be curious. Just when you look at an image like that, what's the first thing that sort of comes to your mind? It'd be really interesting to see what your general, really all of you, I mean, when you see that kind of image, what's the one thing that sort of jumps out at you? Nothing? Is this thing still on? Houston, am I here? Okay. Well, I mean, what jumps out at me is, holy bejesus, this thing's all over the map. It's up to like plus 3,000, then it's to like down 2,000, then plus 3,000, then down 600, then plus 4,000, back to like plus 400. That to me looks like a very confused market. Very dangerous. There is a question of the relevance of OK. Maybe they're a bygone tool. I don't know. But this looks very schizophrenic. It looks very chaotic. It looks very uncertain. It looks dangerous to me. I mean, we spent a lot of time watching this thing just slowly carving out bottoms. Maybe that's what I should have asked you is, do you see the difference, right? Okay, so here is the 1718 peak. Look at the chaoticness through here. I mean, just chaos. And then, when should you have been investing in Bitcoin? So, based on this kind of image, it looks like it was like through here. So here we are going back into chaos. I mean, maybe that's a better image for you to see. Can you see what I mean now? By calm, happy-go-lucky market, feeling pretty good to oh shit. I don't know, folks. This is looking pretty chaotic to me. And as I can't really speak for him, but Mr. Bollinger, he doesn't like to take trades when his Bollinger Bands are expanding. He likes to hunt trades when the Bollinger Bands are contracting and nice and tight. So I get the impression that if he was looking at volatility right now, he'd be kind of like, that's not a good sign. It doesn't mean price can't go higher. I'm not saying that. But is this nice low risk, nice quiet, nice cute little entry into the market here? Absolutely not. So that's kind of why I'm not really too jazzed about interpreting spreads right now. They're just all over the map, which is, of course, classic topping sign. So hopefully that gives you some stuff to chew on. Market cap, totals, the NVT study. We've got a number of different alt perps. I mean, I like to just follow Litecoin, Ethereum, Bitcoin, just see who's leading the charge. I like to watch a bunch of the different stock market proxies and the spread between the shilled stock market proxy and Bitcoin itself. And then these are all about the futures and the forwards. So, also, too, it's kind of a different one, but what I've noticed over the years is that when Tether here, especially after they do a big print and there's a lot of selling in Tether, usually that's a pretty good thing for Bitcoin and crypto. And then conversely, when there's a lot of demand for Tether, it's usually because the crypto kids are panicking. And they want to get out and into some sort of fiat proxy kind of thing. So using this tool and just hunting M's and W's in it just sort of gives me a, like through this period here, I would say I'd be Bitcoin bullish. Then on the big snapback, I'd be like, well, okay, obviously people got the hell out of crypto and ran into Tether. And now Tether kind of M'd out. Okay, we're back to crypto bullish. Then, no, okay. But we didn't break these highs. So you can kind of see that the supply of Tether is overwhelming the market here. But if we start breaking through these lows, then that'll start confirming bigger M's, and that'll be sort of a tell. Right now, you just simply say, yep, on any kind of pumps, it looks like the Tether kids come out, and not actually be the other way around, right? So any kind of dumps in Bitcoin, you get spikes up in Tether, and then when the Bitcoin market calms down, this thing starts to trickle back down again. And we got kind of Emmy behavior in there. So, are we getting ready to do something in Bitcoin here? We might. I mean, they're taking a run up top. We'll see what the CME boys got in store for us tonight and tomorrow. All right. So, hopefully that helps. Okay, in terms of intermarket analysis, what do rising spreads on the 10-year and 2-year U.S. bond signal relative to market indices? Spread on the 2-year and 10-year. So there's a number of different parts to this. You asked this question in the lounge, and I was like, I'm going to be really curious to see what Grim has to say here. It's a pretty heady question. Probably not something somebody who's actually here never traded before would even have the slightest notion of. So clearly you're showing, you've got a little bit of market acumen behind you there. You might have heard it on like CNBC and all of a sudden, oh my goodness, that's all the rage. It would probably take, like an economics professor or something, to really dig into this, to really explain this in detail. I'll try and do my best, but we'll see how this goes. I have no idea whether I'm going to help you or hurt you here. We'll see what happens. This is the matrix that I like to use to follow the interest rate market in the States. And we just basically have some bond prices on here so you can see the spreads between the various different products. You've got the long bond there in teal, the 10-year in yellow, 5-year in green. So you can see, I don't think I have the 2-year on here, which is interesting. But even the 5-year and the 10 years, right? You can see that the 5-year is not really moving. But the 10-year and the 30-year, you can see these spreads are widening, no doubt about it. Here are the yields, and you can and this is the exact opposite. So there's the 2-year yield. 2 years going to follow Fed funds pretty closely. There's the 5-year yield. There's the 10-year yield. There's the 30-year yield. So the question you have to ask yourself here is, what's happening here? Like you can see 2 years, kind of a flat move up. I beg your pardon, 5 years, kind of flat move up. That's kind of that move right there. 2 years, they're not even moving at all. The yield curve is widening, or they call it steepening. Technically, actually, that's a good sign for the economy. Usually when these spreads narrow and they get really tight like this is where the trouble happens in the economy, and this is the yield curve inversion. So the fact that these yields are widening is actually really good for the financial services industry because they continually reinvest at the short end of the curve. That's their borrowing costs. They lend out to the public at the longer end of the curve. And they'll lend you 30-year paper, but it only has to get refinanced 30 years from now. They'll lend you that money. That means they got a big liability on their balance sheet. Well, they'll go and borrow at the short end of the curve. And so in essence, their balance sheet is flat. So in essence, what this is really saying is profit margins for the financial institutions are widening. That's a good thing. But also too here, there's bigger messages going on here. I've been saying repeatedly that I believe that we're at the end of a very long interest rate cycle. So this is exactly what's supposed to happen here. And this will probably carry on for quite some time. And I would imagine this is probably going to get very wide. Which means that this was probably our inversion, because usually recessions, they see inversion. The market broke, and what did the central planners all come in and do when the market broke? They came in and guaranteed the market. Said, you want money? You got all the money you want. Interest rates on the short end, we'll take it right to zero. Financial institutions, you're absolutely guaranteed to make profits. And now, that's working even further in their favor. Financial institutions, they're made in the shade here. And actually, it's interesting because Zach, who is our resident value stock hunter, and I'm very proud of the work that he's done. I think he's got a business if he wants to. He could be a professional newsletter writer in the stock market and make $1 million off of that newsletter, no problem. He's been having us getting really excited at things like insurance companies. Now, why would we get being excited about insurance companies? Because insurance companies write policies on the long end, and they borrow continually, and they collect short-term revenues on the short end. So in essence, the further this widens, the more profit they make. So I would actually say that's probably a good thing for the economy. And it's probably what should happen. Unfortunately, people are going to be looking back at the 1980s as the corresponding cycle, but I don't think that's the corresponding cycle. If we really want to see what our future looks like, I think it's more like the 1940s and 1950s, coming out of the Great Depression. So that means that we look more like this. And I've shown you guys this image before. Boom. Boom. So I think we're in this kind of environment. So I think, that COVID shock, that knocked the market. We've got the Fugazi machine on full printer mode. We've got all the politicians that are probably going to stomach the bankers' plan here. So they've got the green light, but I don't think we're quite out of the woods yet, like growth-wise. COVID is still rampant. It's probably going to take a year or two once we actually get on top of this thing to actually start getting the economies going in earnest. From what I understand, there is one country that I think is basically grabbing market share through this event. They have a very powerful catalyst that they're driving their economy towards in 2025. So as a result, I think there's going to be inherent demand. The vacuum will be filled in. I can see it here in Vancouver. If the central planners had not stepped in and guaranteed the market, this market would have collapsed. But mysteriously, a bunch of capital seems to have come in from nowhere, and these buildings are continuing to go up. So I get the impression that, and it's going to drive this generation crazy. They're going to be constantly looking for that crash, and it just never comes. Because the whole system is rigged to go up now. Klaus knows that this is our future. That's why he desperately wants to get you out of your equity. He doesn't want the millennials to own anything because he knows whatever they own, it's going to go up in value quite a bit. And for heaven's sakes, do not invest in growth. Do not, expect that the future is going to be better. Bury your head in the sand. Rent. Right? Do not own. Do not take advantage of these historically low interest rates and go and pick up a half-decent house. The irony of it all is the bankers are just going to bid the prices up these houses so that it's just really unaffordable for people to buy a house, to even consider a house, to even be able to take advantage of these low interest rates. So, anyway, crazy world. So that's what I think our future is, right? Remarkable, eh? That's a ballsy statement too. I mean, to actually come out and say, well, I think the stock market's about to go fucking apeshit here over the next 5-10 years. Well, that's a pretty ballsy statement. I don't know. Call me crazy. Okay, I hope that helps answer that question to a certain degree. Okay, so I think that they're actually bullish for the economy. On the weekly, a golden cross has just taken place. All right, yep, I can believe that. That would be bullish. Yeah, that would be bullish. The interesting thing there is going to be, do things get to a bit of an extreme? And if this spread gets to too far of an extreme, then that will mean that short-term interest rates from the Fed, they're going to have to start moving them up. But I don't think that's what happens. And the reason why I say that, our inflation-deflation gauge, I think that your yields, that spread, will continue to go up. But as soon as we hit, where the hell is it? Over here? Yeah. I think what happens, and you could argue this is sort of the same thing as your 2-10-year. Think of this as the inflation-protected notes versus non-inflation-protected notes. So, I think your spread works in your favor there, your golden cross, and this is your rally window. But once we, once rates on the longer end start getting up, like 2-3% kind of idea, then I think we're going to start running into some serious traffic. And I think it's these guys that come back down versus the Fed actually having to start raising rates. That's my inclination. And once we get up into this area, we're probably going to find maybe equity prices start waffling, which might actually start, seeing some demand for long-term bonds, and the bond market starts rallying again, which closes your spread. And that's, of course, what Mr. Bond King is desperate for right now. He wants those spreads to close. Mr. Bond King, this is not what Mr. Bond King wants to see. This is Mr. Bond King's worst nightmare. So there you go. But I don't, ironically enough, I mean, we all do charts here. You could see, what the hell's the reload zone of this range? Mr. Bond King might be trapped here for a while, right? The longer dated bond, yeah, that's in teal, right? So that's probably our simple metric when this thing's probably technically done its move. Looks like its top was somewhere in there. There's 50%, so the long bond could still come down a bit more, and that would mean yields going up a bit more, right? There's 2.5%. Remember I said 3%? You can see the yields are going to run into major problems up here at around 2-3%. Once they get up into this area, then you got to start thinking reload zones, right? And reload zones, you're going to actually, then at this point, that's when Mr. Bond King should be stepping in on the buy side. But you can see, holy fuck, he could get absolutely ripped here. So, this is what I'm worried about for Mr. Bond King. I sure hope he knows what it's going to, you can be careful. That looks very, very dangerous. And again, that's helping your spreads, which means the economy is doing a little better. What is kind of cool is, let's go look and see if there are any other proxies in the market that tell us a little bit about the economy. And this is where I love things like the gold and silver ratio. You tell me, when this ratio is going up, it means bad for the economy. When it's going down, it means the economy is feeling good. So you tell me, how's the economy feeling right now? Yay! Finally got an answer. I don't know how delayed the YouTube feed is, but it took almost the whole Jeopardy song there to get an answer. Yeah. I mean, I'd have to say that doesn't look bad. Now, just be careful with this, right? This doesn't necessarily mean that silver is a buy, or gold is a buy, or silver is a sell, or gold is a sell. All it just simply illustrates is what's the demand in the marketplace of gold relative to silver. So when this is emming out, it means that, hey, there's some demand. Somebody's buying this shit to make shit with it. And when it's going straight up, which was the hallmark basically through that entire fear cycle, it was just brutal. It was going the exact opposite direction, and all the silver bugs, they just couldn't figure out why. Why is this happening? And it's just that the economy was really, really bad. And also, too, this is a great illustration of don't invest your money thinking about what the market was like yesterday. Right? Investing your money now thinking that this market state is prevalent is actually, I think, very foolish. We're in a very different market state. We actually changed market states there right on that fucking COVID crisis event. That's what changed this from and what happened? Well, the central banks came out and said, fuck it, don't worry about credit. Hey, we'll give you all the money you want. And all the little capitalists went, fucking hey, man. And of course, the people sleep at the wheel in their hedge funds who really just fucking eating their shrimp cocktails and drinking their champagne in the Hamptons with some chick on their face. They kind of just assumed that everything was business as usual. But the Fed literally changed the rules last March and just said, look, if you're in debt, don't worry about it. So People were building fundamental models. Well, this company's so in debt. Well, they're screwed. They're going to go out of business. The Fed last March just came in and said, you got debt? Pfft, don't worry about it. Well, we'll roll it over, whatever. And all the people were still sitting in the Hamptons going, business as usual. They didn't clue in that something changed last March. If you actually respected that chart, you would actually understand, wow, something really did change there. It's fascinating. And the trend is continuing. It's not stopping now, so I wouldn't get in front of this train. And that's also the same commentary about the bond market, the yields, the spreads, the inflation, deflation. It all ties in together. You think the V bottoms that were formed by the market are going to be tested sometime this year? This low right here, you mean? Yeah, maybe. Sure, why not? You see, this time this year, sure. Fuck, this year is a long time. Somewhere between here and here, that low tested? Yeah, I don't see why not. But remember, this isn't really like, is silver a buy here or silver a sell there, all that kind of stuff. That's not how this works. What I actually think's going to happen here is I think we're going to top this cycle at exactly the 1 year anniversary date of this bottom. I think the stock market's going to top on the 1 year anniversary. And I wouldn't be surprised if Bitcoin tops on that 1 year anniversary. It's weird how this universe works this way. I see this all the time. 1 year exactly, right on the nose. Anyway, we'll see what happens. All right, so good sort of juxtaposition of ideas to help see that, to answer that yield spread question. All right. So a healthy sign of short-term increased investor appetite. No, I don't know whether I would use that. That's not a good way to think about it. This moving in your favor is a validation that the economy itself is moving that direction. Doesn't necessarily mean anything about investors, and I don't think it's actually very good for a technical timing tool. Just more sort of anecdotal market information. What's the economy doing? So, hope that helps. Mumbling manuscript. Okay, next question. What do you mean when you are mentioning Rick is on or risk is off? Oh, okay. At any kind of like the breadth, the bullish percentage, all that. At any given point in time, the market has sort of a mood, and that mood shifts back and forth. There are people rioting in Washington, D.C. and storming the Capitol building. Is that the kind of environment where people are going to be like, oh, yeah, I want to rush out and buy a whole bunch of stock. I'm going to get rich? Probably not. That's like, holy fuck. What the fuck's going on? All hell's breaking loose. So that's probably a really graphic illustration of how dramatically different our sort of attitudes can be on any given day. We say that investors are driven by two words, fear and greed. Are you feeling greedy today? I'm going to bid up assets that can grow in price, and there's growth in demand. Economy is growing. Or am I going to bid up assets that theoretically have an intrinsic value that I don't think are going to go anywhere? Maybe the principal is guaranteed. So that's the simple answer to your question. The easiest way to see that in the market is just simply looking at guaranteed fixed income instruments, bonds, and equity instruments, stocks. These have a guaranteed principal. These do not. So if I'm in a risk-taking kind of mood, I'm probably going to buy the things that don't have that guaranteed principal versus the things that do have a guaranteed principal. That's the easiest way to look at it. I'm going to keep it really simple. And then conversely, if I'm worried about growth in the economy and I'm worried about growth of stock earnings, then I'm probably not going to want to own stocks, right? So that would be that kind of environment. Earnings might be in trouble because everybody is going to be dead. Sorry. But hey, if you don't have live customers, it's awfully tough to sell things. So, in this kind of environment, I'm going to get the fuck out of stocks and I'm going to run into guaranteed investments, government bonds. So I hope that's the easiest way to answer that question. And historically, these have been relatively inversely correlated. And a lot of people, when we get into our risk management module, I guess that's next week, that's this coming week, you're going to be introduced to what's called the efficient frontier. And in essence, portfolio managers try and figure out where their investor or their client, right, financial advisors, where their client falls in what they call the risk spectrum. And usually it's a balance of, perfectly even would be 50% stock, 50% bonds. A little bit more aggressive might be like 75% stock, 25% bonds. And then idiots are 100% in stocks and they have no diversification. So, and actually there's a whole profession just simply rebalancing portfolios on a constant basis, because remember, these numbers are constantly moving. So if I set the ratio on this date right here, right, which is that date, at 50-50, well, this has gone up hugely in value by the time we get to here. That's right around here. So now at this point, even though we started at this point at 50-50, at this point now it's probably like 70-30 because the value of the bonds have gone up so much. So people have to go in and sell some bonds and buy some stock, which is probably what happened through here. And, and just that's a job of portfolio management. So that's in essence what I mean by risk on, risk off. Do investors have a preference for guaranteed investments? Things that are perceived in the marketplace as less risky? Or do they have a preference for riskier assets and they don't want to be in conservative investments? Usually I'll use something like gold, especially when we're going through a fear cycle, but now even more so through a growth cycle. But I'll use gold as sort of a fear asset proxy. It's the ultimate, I want to get out of paper assets. I want to bury my head in the sand. I just want to own the gold. I know it's not going anywhere. So I like to include gold, and what a coincidence. Gold and bond prices often are highly correlated. And then conversely, if we're thinking about growth in this world, energy prices are directly tied to growth. You want to grow? Usually you need low energy prices. When energy prices are high, that makes it harder to grow. So interesting. Fed comes in and guarantees the market. Of course, some shenanigans in the oil business itself. But once everything was sort of stabilized there, you can see oil has come back smartly here. And it's not an accident. Oil and the stock market often move in unison. And then lastly, since the whole Fugazi system, since the end of World War II, was built on the US dollar index system, or this euro dollar market, for a while we would actually use the German mark as a proxy, the D mark. German government bonds, very secure. They would also fall into the risk-off category. As sort of an anti-proxy, though, that I want to get out of the U.S. system, I want to get out of the risk system, a place to hide has been the Japanese yen. So interesting, through the fear cycles, we often see that the yen also acts as, I want to get out of the system, I want to get out of risk, I'm just going to go buy my JGBs and bury my head in the sand. Germany hasn't worked as well because of the whole Eurozone thing and all the pigs nations. You can't really trust their paper that much anymore. So as a result, we don't really watch Germany too closely. But on the flip side, enter crypto. I believe crypto is a great growth proxy. And I believe that in my eyes, it is a commodity. It does represent the future. The millennial generation has definitely embraced the idea. And I wonder, how does crypto act here? Can it go from a store of value story, which is what basically Wall Street was pitched over the past 5 years, which I think did very well. And as I showed you before, I think Bitcoin basically did the job in our sort of fear greed cycle. It did the job that it was I think intended to do in that regard. And I believe that to a certain degree, we often talk about like history as sort of people are motivated to do things. I believe that there were probably quite a few people in this world that were motivated to try and figure out a way to not have gold rally through this cycle. We talk about all of the horrendous amounts of like derivatives products that are issued, this paper gold, that really, if this gold market ever really did actually catch and start to take off, most of these Western countries would probably be bankrupt. And it would be exposed that just like the goldsmiths a million years ago, that they didn't have any gold in the vaults that they've been issuing all these paper fakazis off of. So it's in everybody's best interest to figure out how the fuck do we make sure gold and silver and shit don't rally here. Hello, enter Bitcoin. I would say that, you do have to ask yourself, what is Bitcoin? What is it at the core? The core of Bitcoin is cryptography. Is there any agency within the United States of America that is obsessively focused on cryptocracy? People hate when I say this, but no offense. Does anybody actually know Charlie Lee's background? Does he have any relations with the Bush family? I wonder. Brian being facetious. I like the idea that Bitcoin is a CIA pet project. I've said it before. I'll say it again. Be interesting to see if Vitalik was seduced by the Russians, because after all, he is Russian. And Ethereum is on the dark side. Who knows? But that's silly nonsense talk. I wouldn't know anything about that kind of stuff. It is interesting. I actually sent a tweet, and of course, like he'd ever reply to me, right? But I sent a tweet specifically to Mr. Vitalik and said, I remember, Mr. Vitalik, right here, you said publicly, you are making my supercomputer too expensive for the world to use, and I would prefer it to be down here, please. And I asked him, well, how do you feel about your supercomputer right now and the price of your asset? Crickets. Oh, goodness. One funny thing about Ethereum here is, Actually, what's ending up happening here is people can't use this thing. There's only one group that's using this thing, and they don't seem to give a fuck about transaction fees. I actually saw people saying, hey, if I can lock in an $8,000 gain, I'm happy to pay $1,000 in fees. What? Where's the economy of scale here? It's a bit silly what's going on here, folks, but oh well. Doesn't mean the silliness can't go on. You know, the problem here is, what's the 1%'s plan? Half of this world operates on some fucking guy, you know, standing behind the green curtain operating levers. If we could somehow figure out what the 1%'s plan is, then you actually know when this shit's going to break. I've told you guys before, I remember they used to call it the 7 tigers of Asia. And the growth in Asia was endless. And then all of a sudden, Hong Kong was transferred from the Chinese, from the British back over to the Chinese. And within a fucking month, boom, the whole market collapsed. And then it turned into the Asian contagion. And I remember Korean ladies were running out into the street with their silverware, throwing their silverware into the streets, trying to save their currency. I mean, you guys probably don't even remember those kind of environments. I've lived through a number of them where you couldn't, you know, fucking people were going crazy to the bear side. So, you know, now we're in crazy to the bull side. And people just think, okay, this is the way it is. Actually, it's kind of interesting. Who could tell me, and it's kind of funny that I have this image on the screen, who could tell me what trading system do we like to follow that's actually, I think, giving us a signal there? And it's so hilarious because I think the guy, like, told his entire community to just fucking load up the boat. So it seems kind of funny that the trading model that he built to help him trade the markets is actually giving a little bit of a warning sign here, eh? That's fascinating. And look at the divergence in that RSI. Wow. That's incredible. I'm surprised that RSI momentum, eh? That just looks like a train wreck. Huh. Son of a gun, eh? Tell ya, that doesn't look very bullish. I suppose you got a little bit of bullishness in here. So it's almost like, you know, when I do my little RSI studies, I'm like, all right, is this the first W? Is this the second W? So it's almost like we got a W, then we got an M. So the whole market's just sort of like, stop, don't do anything. And whoever wins this battle, if we go and W out here and break out through the top, look out, that's going to be big. But conversely, and this is what I like this trade, if we break down through here, you can see that becomes our second, right? And that should be yellow. And we all know what we're supposed to think if we see yellow breaks through, what's that number there? Oh, that's the 50 line! Oh, holy shit, Muslim! So I tell you, this thing's like sitting right on edge right now, just going, if this RSI gets down through here and you see a print below there, oh man. What do you think about the sound effects, Andre? You like the sound effects? That's interesting. And nobody answered that. What happens when we get an M in OBV, RSI, and Willie all at the same time? That's not a good sign. We haven't really broken down on the OBV. And there's the M. So you can see the bears, they're not quite, like the bears, they're waiting for this CME event, right? If this goes beep and opens up and the fucking CME just starts shitting on this thing, oh, those futures contracts, this'll just crap right out. Well, it's interesting. You can see, volume impetus. I guess level oneers, you'll do this in a bit. You can see the bulls, they fell asleep. You can see the bears, they fall asleep. So we're just waiting. And you can see the bears are starting to get a bit chunky here. So we got a little bit of an M. Do we start breaking through this moving average? Oh boy. So if anything, if you're a bull, you're just like, fucking stay asleep. Do not wake up. Do not wake up, you sons of bitches. Wow, that's fascinating. If there is somebody that happens to be watching one of these, maybe send him this chart and just say, hey, heads up. That Beamish guy seems to think that your little setup is trying to speak here. Who knows? All right, how'd we do on those questions? Did we finish them all? Okay, so whoever asked this question, does that make sense what I mean by risk on, risk off? Yes, no, maybe so. Going once, going twice. Sold. We turn off computers. Oh, yeah. Okay, well, I think we'll call it a day at that, folks. We started a bit late here, so I got to go get pretty for Liam. I hope you guys enjoyed that offering. I know you guys wanted me to look at one or two names. Peter says I paid $22 to transfer some ETH. That was 2 days ago. Is that a high number or a low number? This guy says I paid $10 and the transfer failed. Oh, shitty. EOS, I don't know whether it refers to BTC, but we have one guy on the site who actually I had the pleasure to have a beer with when I was over in England. He's a really just a outstanding gentleman. Dave. And Dave actually is, if anybody's going to do fundamental research into crypto, and I listen to what they say, it would definitely be Dave. Obviously, do with what you will, with what you please on things like Doge, but you can't fucking buy that. That's ridiculous. But Dave actually gave me his kick-ass fucking list here. This is his scream names. It's so funny, like Sjord, of course, he's all bullish of LTO. I think he's done pretty well on this. Yeah, I mean, it's a pretty good trade. Way to go, Sjord. He's all bullish of this Luna, but fuck, you can't buy that now. Boom, gone. See you later. We'll keep an eye on that down the road. I thought this was funny. Here's a great illustration that you never trade off of just one indicator. If you were a fan of Tom DeMark here, you would have sold, and of course, boom, Merry Christmas. So probably not a good idea to just trade off of one indicator. I was joking on the lounge earlier today about that. But EOS, so somebody was asking about this. I really like the look of that chart. That's a good looking chart. Look at that. That's perfect. Really good looking. So whoever was looking at that, you're definitely heading in the right direction. This shows to me you're a smart investor. I mean, obviously there's no guarantees in any of this shit. But you've got a pretty well-defined risk window here to work with, and the upside is substantial. So you're definitely thinking in the right direction. Good job. Let's see. All right. I think you guys were asking for a couple names up top. What I would suggest you do is take a screenshot of the names that are on the screen right now and save those names. This is Brian trying to help you. Are you listening? I don't think you are. No, I don't see any others. All right. I guess I'll leave it at that. All right, so I hope you had yourself a good day. Wish me luck with Liam. Great job, level oneers. Get a W on the other side of trend lines here. We can start thinking bullish again. I think probably the market's going to get a little bit crazy through this ETH listing event, so there certainly won't be anything I'll be doing. And actually, there are a couple names that I was buying recently. If anything, I love the idea of maybe letting a couple of the dogs go into the dog pound and then just going and picking up some kitties. There's a cute little kitty. I like Kitty. Have I told you how much I like Kitty? I like Kitty. Here's this one. Look at that. I mean, why is it a dog can rally but a cat can't? What the fuck? Is this? Are these guys like? What do you call that? Discriminating against other animals? I'm sure there's a name for it. But this is the kind of name where I could come in and I'll be selling into the spring and stuff. So there are names out there. In fact, there's a few that I like that I'm working bids. You can see XTC got some bids there. That CND I'm interested in. BitTube, I love that one. That one looks perfect right in there. That's Justin Sun, right? Justin Sun, he loves to rally in the summertime. Look at that. It's just sitting right in a reload zone. So there are lots of really cute names, and I actually think that this summer could be one hell of a fucking altcoin rally. I don't see the Fed cutting the cord just yet. I think probably we'll have to get well into vaccination world. Feel like we're sort of beyond the other side of this event, and then we'll probably have our day with a reckoning or whatever. But through the summer, I don't really see a hell of a lot of dump. What I'm worried about here, honestly, what I'm really worried about is, you have the, this is just, what's this range here? That's the whole damn thing. This must be a log chart. Yeah. There's 38.2s, right? That's 27 Gs. This is very risky stuff. That's a lot of dollars. I hope, for everybody's sake, that we can put in some sort of W here. If we can put in some sort of W on the other side of this damn trend line, then we can start thinking bots and continuation. But right now, can't touch that. Anyway, slow and steady wins the race. And as I said, if you can just, like I said, just try and avoid, like this has trouble written all over it. But that EOS, that doesn't look like that. That's just sitting there down there doing nothing. So that's the kind of stuff I'd want to take a good look at. That's the kind of stuff I have to just say, you know what, this thing's got to just cool down and just leave it alone. So hope that helps. Anyway. Okay, I'm going to stop the rant now. Have yourselves a great day, everybody. All the best, and bye for now.